First of all, good afternoon, everyone. Thank you for joining us today for Argus Online Energy Forum. Uh, I know it's a tough time going on in India, but we still hope to continue to help our clients to understand what is happening on the global oil markets. I would like to deeply thank Meenakshi and Pulkit from the IT team for helping us out on setting up the agenda and helping with coordinating the days and venue. I would like to introduce myself. My name is Parimal. I'm the Global Account Manager for IOC Group of Companies. I am accompanied with Ms. Prachi Tiwari, who handles the client success management of trainings side of things. So today we are having two presentations, mainly by Mr. Francis Osborne on crude market outlook. He is at Argus appointed as head of forecasting in the consulting team, followed by Mr. Alejandro Barbajosa, who is the VP for crude markets based out of Japan. So moving forward, I would like to just request for all the attendees to switch off their camera and mic while during the presentation. So it is so that everybody can see the slides all the time. Sir, it will be good if you can switch off the camera. Otherwise, it can stop. So moving forward, we'll be recording the presentation, and we'll finish the presentation when the recordings during the presentation, and the Q&A will not be recorded. So feel free to ask any questions after the presentation. So on that note, I would like to request Francis to take over and start the presentation.
Very good, thank you, Parimal. I'm just going to make sure that there we are. Well, good afternoon, everybody, and I trust, I hope very much that you are all well and bearing up at this very difficult time. My name is Francis Osborne. I work in the London-based consulting team within Argus. My title is Head of Forecasting. I've been with Argus about 8 years now, and I'm responsible for developing and coordinating all our forecasting activities across crude and refined products. I've been in the industry a good many years. I've lived through quite a number of cycles, both up and down. The current market is, I think, as interesting as I can ever remember. As a forecaster, it's probably the most challenging environment that we've had to operate in for well, probably forever, to be perfectly frank. What I want to do is start off this virtual meeting by providing you with some thoughts around the crude outlook, where we think the market is at the moment, where we think it's headed, and of course what we think the price is going to do. I'm going to leave it relatively high level. I don't want to overburden you with too much detail. Clearly, if you require more detail, we're always accessible. You have only to ask Parimal, and he can put you directly in touch with us, and we're happy to field whatever requests and queries you may have. So let's just start off by considering what OPEC Plus really has been thinking of over the last few months. As I'm sure you will all be aware, under the production agreement which they put together in the face of the pandemic when it first struck in the second quarter of last year, they introduced, as we know, the most extensive and impressive round of cuts that the market's ever experienced, and it was a correct reflection of the seriousness of the situation back in 2020. Under that agreement, at the beginning of this year, they could move to what we call phase 3, and that was an increase of just a little over 2 million, just a little over a million barrels a day would be permitted under phase 3, and they actually decided not to go along with that. They correctly identified that the COVID situation was still uncertain. The outlook for global demand growth was still equally uncertain. And they chose, under the leadership of the Saudis, to be very pragmatic and in order to keep a very firm grasp on the market and the rebalancing exercise that they had very successfully been pursuing for the previous 9 months. They decided to forego that increase. In fact, as we know, the Saudis unilaterally announced and very much surprised the market by saying we're going to cut another 1 million. We don't expect anyone else to do it. We're going to do it on our own. And that is an indication of just how seriously we're taking our role of market guardian, really. And that was very much one of the reasons, along with the start of the rollout of vaccination programs in the US, in the UK and various other countries, around the world. It was very much a reason why the market became actually quite bullish, and we've seen the price steadily appreciate to trade at the moment very close to $70, and I'm speaking about North Sea dated Brent here, and it's been very well supported, the price. The most recent agreement or meeting, if you like, the last meeting was kind of skipped in many ways, but if we go back to March, they actually decided, again rather surprisingly in view of the market had expected the OPEC Plus group to just continue to roll over the cuts, but the Saudis actually agreed and were happy to go along with pressure, I think, from Russia and others within the group. They finally agreed to start to release the phase 3 volumes back to the market, and at the same time they would put back into the market the 1 million barrels a day that they had unilaterally cut. So the market is actually in the position now of having to accommodate the supply of 2.1 million barrels a day in total, which will be phased in over the 3-month period, May, June and July, as indicated on the left-hand side here. And I think they finally agreed to do this because prices were clearly well supported, excuse me, but equally the rebalancing progress is very well advanced. The data is not great, so we have to live by estimates, but on our estimation we would say that the rebalancing process is probably about 50% complete, or at least it was at the time of the March meeting. Back in at the end of February this year, we would say that the surplus inventory that accumulated back in the worst point of the pandemic, back in Q2 2020, about 50% of that surplus inventory had been drawn down. So the rebalancing process was well underway, prices were well supported, and the Saudis and others within the OPEC Plus grouping, I think, felt comfortable enough that there was light at the end of the tunnel, and they could start to reel back the cuts that they had been. Excuse me, frog in my throat today. And the market has been actually very complacent about this. There's been no price weakness at all. If anything, the price is continuing to push upwards. So the market is really quite happy to see these volumes come back in. It's a bit of a gamble. because the demand recovery is still not complete. Certainly, as I've said, the stock position has certainly significantly improved. If we look around the world, and I'm thinking here of the floating storage data that we have. The floating storage is the marginal storage play in the system. It's the most expensive. It's a very good indicator at the margin of where we are in terms of global inventory. Gasoline is pretty much balanced again. I would say middle distillates, diesel and jet fuel, still looks a little bit surplus, a bit long, but it certainly is much improved, and crude equally doesn't look terribly out of line with historical averages. So the stock's position, as I said, is certainly much improved, but that is a tribute to the very rigorous production restraint that OPEC and its non-OPEC partners has been able to see through in the last year now. But the demand picture is still looking a little weak. We recovered very quickly the very significant loss in demand back in last April when lockdowns started to be eased about 2 to 3 months later. Then a lot of that demand was recovered. If we think back to your own situation here in India, a large portion of the loss of demand and sales that you recorded back in April, I would say about 2 to 3 months, 3 months later, probably around 70 to 80% of that loss had been recovered, and by the end of the year you'd recovered pretty much you pretty much got back to pre-pandemic levels. It hasn't been quite the same in other regions. The US still, it's probably about 1.5 million below pre-COVID levels. So if we look at the latest monthly sales data, we compare it, and these are for main transport fuel products, gasoline, distillate and jet fuel, compared to 2019, the same, the first quarter of 2019, then US demand is 1.5 million lower than where it was. Europe is exactly the same. It's probably closer to about 2 million below where it was pre-COVID. So the demand recovery has very much slowed down, and it has to some extent stalled. That's in the OECD regions. If we look at some of the key emerging markets in China, where the data is unfortunately there is no official data for oil demand and sales, so we have to live by calculation, or in this case, what I'm showing you are the reported domestic sales of gasoline and diesel reported by Sinopec and PetroChina, the two largest domestic retailers of product. It's only a partial snapshot of what's going on, but I think it's probably a fairly decent reflection of what I would suggest is a relatively flat demand profile. I don't personally believe that Chinese demand, certainly through Q1 of this year, has been showing any particular strength at all. In fact, Q1 was certainly a little lower than Q4 of last year, looking just at this metric. Now, it is probably true to say that Chinese demand in overall terms is only now, and we're in the one of their holiday seasons. The May Day holiday week is traditionally a pretty strong time of year in terms of oil demand. That is probably seeing, I think, Chinese demand back broadly at pre-COVID levels, but really the outlook isn't particularly strong. And if we turn to India, yourselves, Brazil and Mexico, equally demand has recovered from last year's collapse, but it's showing no particular strength. And of course, Unfortunately, with the pandemic picking up in recent weeks and months in your own economy, and we would expect obviously oil sales and oil demand probably to fall back quite significantly. We're making an estimate, it's a pure estimate, that may see Indian demand maybe 1 million barrels a day down on last month, on April. So in overall terms, global oil demand is still, it's better than it was, but it's not growing that strongly. Trade is certainly, global trade is certainly recovered. It's kind of back to positive territory. So we've recovered a lot of the slump, depending on which indicator on the left that you look at. But really, trade is still relatively subdued compared to historical levels. And of course, on the right-hand side, we have yet to see any real recovery in global air traffic in terms of passengers. Certainly, internal flying in the US and China has certainly recovered a lot of its strength, and it's relatively strong. But globally, nobody is flying still. Very, very few. In Europe, it's still virtually impossible to fly anywhere. We in the UK are about to be allowed by our government to start going abroad again, but until another week, it's still banned to take an international flight. And this is going to last as long as the COVID situation remains with us. And therefore, in terms of global air traffic, we don't believe that we're going to get back to a pre-COVID situation until about probably 2023 or so. It all does depend clearly on the rollout of vaccines, just how quickly the COVID situation comes under restraint. If we just extrapolate our the recent trends, then at what point we can expect herd immunity to have been achieved clearly depends critically on how far advanced a particular country is in terms of the vaccination program. But on basis of current trends, then the US is probably going to get to herd immunity by probably about July or August, very much the same period or timing that we expect in the UK. Across the Eurozone as a whole, it's probably not going to be until the end of this year. And if we look at, for instance, India, then again, we wouldn't expect on the basis of current trends, I'm afraid, herd immunity to be achieved until probably the end of 2022, perhaps. So clearly, in this kind of environment, then there is always going to be a question mark over how quickly global demand does return to a healthy state, a healthy pre-COVID level. So it all very much continues to depend on production restraint. As I say, I can't emphasize too much just how successful OPEC Plus has been. It's been very ambitious in its strategy of withholding production, and it has by and large been very, very successful. There are obvious points of weakness within the organization. For instance, Russia has only in 1 month since last April actually adhered to its agreed cuts. Otherwise, it has overproduced. Iraq steadily overproduces. Nigeria does as well, but it's more than compensated for by the Saudis themselves and others who have kept more than they needed to, or had originally agreed to. That their cuts have overcomplied, if you like. So it's this that has allowed the global surplus inventory to draw down, and there's no reason to believe that they won't continue to be very diligent in withholding barrels from the market. And if we project forward to the end of this year, then even without a really strong global demand recovery, then we would still expect the rebalancing exercise to be very much on course. And depending on exactly how much oil we should take out of the equation because of builds or increases in working inventory in new refining capacity and pipeline and storage infrastructure, then I would suggest that really probably we are virtually rebalanced by the end of this year. So I'm showing a figure here, it's just a calculated number of about 350 to 400 million barrels. A large portion of that is probably never going to be returned to the market because it's gone into strategic storage or, as I say, working inventory. But very much we're in a fairly balanced position by the end of this year, and that is quite price supportive. The one thing that we now have to keep a very close eye on is Iran. Iranian barrels are returning to market. The data is by necessity somewhat opaque. China is almost certainly importing, probably on a fairly consistent basis now, about 400,000 to 500,000 barrels a day of Iranian crude. It doesn't turn up in the official statistics for crude imports, but we can identify using vessel tracking data a large volume of oil which apparently does not have a designated source coming into China. So these are barrels which we can observe arriving, but nobody quite knows where they've started their journey. And I think it's a fairly reasonable assumption that these are Iranian barrels which are shipped abroad and then transferred ship to ship, perhaps offshore Malaysia or somewhere like that. And equally, we can identify probably Venezuelan barrels coming into China as well, possibly as much as 400,000 to 500,000 barrels a day of Venezuelan crude, which again appears in the statistics and the data as a product called diluted bitumen, but most people think it's merry crude from Venezuela. So these are barrels that have been probably traveling for some time. But I think the important thing is the Iranian crude. It's quite clear that with the new US administration much more amenable to achieving a deal and some kind of a rapprochement with Iran, that the chances of Iranian crude exports flowing more freely in coming months is significantly increased. We do not expect any formal end to sanctions until probably the first half of next year at the earliest. I think it's going to take that sort of time frame to negotiate a deal, but it's quite possible that there will be a steady increase in leakage as this year progresses, and this could be this will be an unwelcome additional task for the remainder of OPEC Plus to deal with. There is no sign of any recovery at the moment in non-OPEC production. We focus very heavily on the US crude situation. The US crude production has not, it's recovered from where it dropped back in Q2 of last year. All the barrels that were voluntarily shut in because of low prices have returned to the market, but there is really no sign of any sustained organic growth in US crude production and output, and that's a function of the fact that investment levels are still well down. Operators are pursuing capital discipline very astutely and successfully. the US shale industry has never, until probably this year, made any profit whatsoever. It's been it's been the most extraordinary example of value destruction. They have consistently overproduced and just produced barrels for the sake of barrels rather than profit for the sake of making and delivering a return to their investors. And this has got to change, and it has changed. Today, the industry as a whole is only reinvesting about 50 to 60% of free cash flow. The remainder of free cash flow is being used to pay down debt, repair balance sheets, and actually return equity to investors. So in a very short space of time, the industry has moved from unprofitable to profitable, but it's at the expense of investment levels, which in turn are only just enough at the moment to offset these steep decline rates in the existing fields. And one of the other things that is become very apparent this year is that the hedging program that the US producers have put in place, it protects it from prices below $45 WTI. But it also means that there is very little upside once the price gets over. It's probably about $52 or $53. Anything above that is actually money wasted or money not accrued to the producer, because they've hedged using collars in order to contain costs, and these collars mean that any upside above $52, $53 just goes to the provider of the hedge rather than the companies themselves. So at the moment, because of this hedging policy, which is understandable and put in place because I think no one truly expected the price to recover quite as aggressively and quickly as it has done, because of this, until these hedging instruments expire, which is probably early next year, despite the strength in prices, the industry remains relatively and voluntarily cash constrained in terms of new investment. I certainly expect, assuming that the price of crude remains at least at around current levels, which I believe is probably going to be the case going forward, then once these hedging programs unwind, I would expect to see investment start to increase. So next year and going forward into 23, I think the industry is going to be much more competitive. I don't know if the OPEC Plus agreement will be renewed when it expires next April. I've assumed it probably won't, because I see no real appetite in Russia. I think they're looking to exit the agreement as quickly as possible. So I think next year, in the second quarter, there will be a large increase in very short time in terms of non-OPEC supply. And then I expect to also see US production starting to grow, probably through the second half of next year and into 23. So it's a much more competitive environment. The call on OPEC, because it may well just, as I said, my working assumption is it will only be OPEC by then. The call on OPEC will be relatively constrained. OPEC production is shown on the right-hand side here. This includes Venezuela and Iran, as they are currently producing in the blue bars. If we then factor in if there were no additional Iranian exports in 2022, then the blue bar would be aligned to the top of the yellow portion there, so around 27 million barrels a day, and that clearly would allow Saudi and others, for instance, to produce much more than they will if Iran returns. I think the the purpose of the chart on the right is to illustrate the fact that when Iran does return, and I think they definitely probably will return in 22 and 23, they may well get back to around 2.5 million barrels a day of exports by 23. That is market share that Saudi, Kuwait and others will have to forego if they want to keep the price of crude supported, which I think they almost certainly will do. So it is going to be a very difficult task for them. They will not wish to give up market share, particularly in the key Asian market, to allow Iran back into the market. But frankly, they have no option if they want to keep prices at levels which are acceptable for revenue raising purposes. And if we just look a little bit further ahead, there is obviously a lot of concern about what's happened in the upstream. There's absolutely no doubt that upstream investment last year was very heavily impacted by the fall in prices, and that's obvious. Something around $230 billion had originally been planned for upstream investment, and in the end it was less than 50. So there has been an enormous loss of investment upstream, and many people are expecting this to impact non-OPEC production going forward, and some are suggesting that it's going to underpin a very significant upward move in price. I'm a little skeptical of that. What we can identify is that there are a wide range of projects that have been delayed and put temporarily on hold until things improve, but those projects will continue to come to market. They're just going to be a little slower than they had been originally planned. And if we look across the non-OPEC producing regions as a whole, over the next, let's just call it 10 years to 2030, we still see very sizable increases in production from the USA, from Brazil, Guyana, for instance, in Latin America, from Canada, and indeed from Central Asia and also some in the Middle East, although that is a lot of that is gas liquids. Asia Pacific looks as though it's probably terminally in decline. Russia is also possibly going to decline in production, although this would not include the very key Vostok project. Vostok oil is being developed potentially by Rosneft. It's an Arctic group of fields, some of which are already in production. But the plan is to significantly increase production in that region to the point where in the early 30s it could be producing 2.5 million barrels a day. We haven't included that as a firm potential development yet because it's extremely expensive. It's very challenging in terms of climate, environment, and infrastructure generally. We would want to see a little bit more concrete evidence of development work underway before including that in our projections, but it could significantly turn around the profile in Russia. This oil is, by the way, very light, very sweet, very high quality crude, which will eventually find its way to Asia if it's developed. Just to end on the price outlook therefore, this year, for the rest of this year, we still believe that the current upward move in price is more of a shall we say, a speculatively driven development. I think it's the market buying into the undoubted recovery in the US economy. The US economy is certainly developing or recovering quickly, but it's in terms of the global marketplace, it's very much, I wonder just how much the US on its own can actually drive a recovery across the globe. There is very clear evidence that large portions of the world, certainly in the emerging markets and the low-income economies generally, have not been able to pursue stimulus anywhere near in terms of expenditure of GDP in low-income countries. They've only spent about 1% of GDP on post-COVID recovery measures. So it's very much a two-paced economic revival. The US certainly leading, possibly China as well. The Eurozone to some extent is lagging, but large portions and parts of the world are going to, I think, struggle economically over the next over the coming months. And therefore, I just wonder just how sustainable from the point of view of fundamentals the recent price rally is, and as a consequence I'm suggesting a relatively more bearish outlook with North Sea dated probably sticking closer to $60 than $70 a barrel, and then to reflect the more competitive upstream environment vis-a-vis firstly returning Iranian barrels, and then as we move to 23 an increase or recovery in US production. I think the price will remain under pressure, and therefore we paint a picture of probably a price in the $50 to $60 range. But there is on the right hand side, how we get to our estimation or our forecast of crude price, we build it up from a long run marginal cost for shale, which is probably around $50 a barrel in constant dollar terms at the moment. The uplift is simply a subjective value or additional uplift in price, which we can attribute to how competitive the market environment is at any point in time and how successful OPEC is at managing the market, because they will have to continue to manage the market, otherwise the price will be under pressure. But I doubt very much that the price can fall much below $40 for any significant period of time. $40 is, if you like, probably the bottom of the long run marginal cost range for shale production. If the price were to fall again below $40, we would expect to see US production shrink very rapidly, and the price would rebound as the market rebalanced itself. But I don't expect that to be tested, because I think OPEC will continue to manage the market on an ongoing basis for the foreseeable future. And I'm going to leave it there. I've certainly done my 40 minutes or so, so I'm going to hand you back to Parimal to take over. So thank you very much for listening.
Thank you very much, Francis. The presentation was very, very insightful.
My pleasure. Thank you for listening.
So a very good afternoon to you. It's a pleasure to have the opportunity to reach out to IOC again today. I am sorry that it has to be under the current circumstances, but at the same time, it's very reassuring to see that we have such a high level of attendance for today's session, even under the current circumstances. So to the degree that it's possible, we would like to ensure that you always think of us as being close, both in terms of any questions you may have and information, but also in terms of our wishes for each and every one of you and your families, for to be able to overcome this situation as soon as possible. So I'm going to share with you the slides that we will be showing, and please let me know as soon as they're up on screen. Can you see them now?
Yes, we can see.
Okay, great. Thank you. So over the past few weeks, as Francis pointed out, there has been a growing interest among the global oil community, particularly in Asia, but also I've been speaking to, for example, producers in Latin America recently, who are extremely interested about what's happening in India, not only in terms of demand. This is even before we saw the current situation with demand, because India has been remarkably flexible and nimble in adapting to a fast-changing supply environment. And that's the story that I'd like to focus on today. Use India as an example of how the global oil market and the pricing mechanisms for Middle Eastern crude have had to adapt and evolve to a scenario where the multiple sources for crude contribute to the ability of the end users to have a much greater say in terms of where they buy the crude from, and also at what price. An example that I want to give you, which is not the typical US barrel, but also comes from the Americas, is Canadian crude, and how Canadian crude over the past few months has become such an important source of marginal supply, especially for the some of the biggest Indian refineries. And it is in that sense that India has probably gained weight beyond its share of the market in terms of being able to set the price and in terms of being able to send the right signal for producers in the Middle East to price their crude accordingly. And that's really the biggest story that we've seen over the past decade. The emergence of alternatives from the Atlantic basin, and the fact that also India stands right at the gateway of the Middle East, but also closer to the Atlantic basin crude than virtually any other major buyer of Atlantic basin crude in Asia Pacific, really has set India apart in terms of that flexibility. And later we're going to see some of the data that backs this up that you'll be very familiar with. But I still think it's very important to capture the importance of the role of Indian refiners over the past 5 years in leading and the diversification efforts and having a much greater say in terms of price formation. That especially in the current situation, or since the start of the pandemic a year ago or 15 months ago, has also forced Middle Eastern producers to accelerate the modernization of their pricing mechanisms, because otherwise they're going to fall behind in terms of pricing, and their crude will not be as competitive as it is, and it will be a lot more difficult for them to actually find markets for that crude in a situation where they can't adapt to that new market reality. So are you seeing now just are you seeing full let me move to full slideshow, because I don't think, this should be better now, right? Are you able to see the full screen now?
Yeah.
Okay,
Yes,
and had I moved already to this slide earlier, or is it the first time you see this slide?
I'm seeing the second slide.
Okay, so you have already been, but you know, this is basically a summary of what I was just saying, and the latest reflection of that evolution of pricing of Middle East crude is by far what is happening with regards to Abu Dhabi crude, and the fact that the UAE, the United Arab Emirates, has taken the almost unprecedented step into, at least in terms of the volume that has been floated onto price on a market-based mechanism fully, without any intervention from the state oil company to set OSPs for such a big proportion of Middle Eastern crude production. This is, of course, not only Murban, for which production is close to 1.6 or 1.8 million barrels per day, but also includes Upper Zakum, Das, and Lulu for total UAE production of close to 3 million barrels per day. So this is a very important development, because it's not only the flagship Murban contract on the IFAD exchange that is now having an impact on the pricing of that segment of the market, where you see Murban competing with the crude coming from the US, with the WTI, also with North Sea crude, to a degree with West African lighter grades, and also with ESPO from Russia. We also see Upper Zakum being priced now at a differential to Murban, and also sending a very clear pricing signal to that segment of the market, the medium sour barrel, where you see Abu Dhabi crude competing directly and head on with Saudi barrels, with Iranian barrels, with Omani barrels, with Qatari barrels. So it's that construct of pricing and that relation between the price of Murban and Upper Zakum in particular, that is revolutionizing the way that participants look at the value of these grades on the market. And this is something that we will be taking a close look at as we go over the presentation. But first, let me just look at some of the developments over the past years that have taken us to where we are. And this is something that we have discussed with you before: the resilience of US crude exports on a global basis, and in particular to the Asian market, despite the decline in US production, as Francis showed, by close to 2 million barrels per day a year ago, but still, I was looking at his chart for US production, now about 17 million barrels per day compared to the 18 million barrels per day that we were seeing a year ago. So still US production significantly affected by the leftovers or the long-term effect of the drop in production, the drop in prices, and the hedging mechanisms that Francis was highlighting. But interestingly enough, the amount of crude that the US is putting out onto the global market is pretty much unaffected, and is pretty much steady from 2020 and from 2019 at about 3 million barrels per day. There are lots of questions about how soon that figure is going to grow again. And, in the past, we have shared that perhaps later this decade, we could see US crude exports rise towards 5 million barrels per day, but certainly not in the very short term. And still, we see sustainability for those 3 million barrels per day. And as you can see here, in terms of the regions, Asia is now taking virtually 50% of those exports from the US. Now, how does the pricing of that US crude take place in the Asian market? Well, it's the marginal barrel that's coming from the Atlantic basin, mostly from the US, that is directly competing with the similar quality crude that is coming from the Middle East. And in this case, Murban from the UAE stands at a very unique position, because it competes directly with WTI, and it competes on a daily basis in such a way that whenever there is an opportunity for the ARB to open in favor of WTI, Murban will suffer in the Asian market because WTI becomes quite competitive. And whether it's the Chinese or the Indian refiners or the South Korean refiners or Taiwan CPC or the majors in Singapore or Thai refiners, they will all have the ability to take US barrels upon short notice. And that's a feature that was not there in the market only a few years ago. That's how the steady flow of US crude from what used to be just an arbitrage play to a base load. I don't want to say base load in terms of it always goes to the same places, but in terms of overall volume to the Asian market, certainly US crude has become a baseload source of supply for Asia Pacific as a whole. It's still very reactive in terms of where it goes, depending on prices and depending on the alternatives that each of the different refiners in different markets across Asia faces at each point in time. But there's no doubt that the pricing relationship between Murban and WTI today plays a key role in how quickly those flows of US crude will find homes in Asia, or how much they will struggle in a more difficult environment. So if we look at the recent trend in imports of US crude by Asian refiners, and this is another reason why at the beginning I was saying that there's a lot of interest outside India and even outside Asia and the Middle East about the role that India is playing now. The key question that many people have in the Western Hemisphere, among them Latin American producers, is how long can India sustain imports of US crude at the very high levels that we have seen over the past few months? As you can see in this chart highlighted in brown, which is the color for India right here, over the past 3 months, India has been the biggest importer of at least the last 3 months for which full data is available. We have seen that India has taken the lead as Asia's biggest buyer of US crude. It's true that at any point in time, China can come back and snatch that title very easily. But it's interesting as well that another steady buyer of US crude that grew to become at one point about 2 years ago the biggest buyer of US crude when China stopped buying so aggressively because of the emerging trade dispute with the US. We see that South Korea is no longer taking that leading role and that it has given that place to India, and that now India constitutes the biggest outlet for US crude in Asia. And other suppliers of crude to India, especially heavy sour crude producers, are looking at the sustainability of these flows into the Indian market, not necessarily because there's a match in terms of quality, but most likely because of the co-loading synergies that emerge between US crude, namely WTI, and Latin American grades that they assume, or that we know, are being blended across Asia Pacific, and in particular have been blended in the past in India to come up with a desired quality for refineries, for complex refineries in the region. So obviously, when an incremental barrel of WTI, which is the grade that is most widely available for export and for import into the Indian market and in other places in Asia Pacific, the refiner, the key question that they have is whether they'll have something else that they will be blending with that WTI to come up still with the desired quality and the desired slate that they are looking for. And in that sense, Canadian and Mexican crude stand out as some of the key complements with US crude because of the proximity of the loading facilities around the US Gulf Coast. Of course, in the case of Canadian crude, right at the US Gulf Coast and virtually in the same locations or very close to where WTI is loaded. And in the case of Mexican crude, just across the Gulf of Mexico in a very short sailing trip that still conveniently allows for the co-loading of cargoes. So the sustainability of US crude flows into the Asian market is a key metric or a key variable that producers are looking at, not only in the Middle East as they modernize their pricing mechanisms to react and to better compete with that US crude, but also it has the Latin American producers looking closely at those flows And since India has been the biggest receiver of those flows recently, there has been an unusual amount of attention on the Indian market. And that is why we highlight that as we go forward, the latest figures being for April, we expect that in May, as Francis said, and this is his forecast, about 1 million barrels per day of consumption from India will be gone as a result of the COVID surge. But beyond the forecast, I'd like to point out to the trend that we have seen over the past the previous 3 months, or basically the first 4 months of this year, where you see in gray the Americas volumes, and you can see that those Americas volumes, for example, here in February, reached almost record levels of about 1 million barrels per day. And now they have declined, but US crude continues to play a very important role in those flows. There are lots of questions about what volumes are going to suffer as a result of the decline in demand from Indian refiners going forward. And it seems that because of previous commitments for Middle East crude, it's likely going to be Atlantic Basin crude, and namely US crude, that will be suffering from that lower demand from India. But at the same time,
the slides are not moving.
The slides are what? Sorry?
Are not moving. So if you can confirm which slide are you on?
Okay, so what slide are you seeing now?
Second slide. I'm not sure the others are seeing the same.
Meenakshi, what slide are you seeing now?
Yeah, slide number 2.
Still?
Yeah. Actually, I'm moving the slides manually only.
Oh, okay. So you have access to the slides.
Yeah, we can move the slides. So you have to tell us which slide are you on.
So now that I'm moving, can you?
No, I think if you can have the control in yours, at your end, it will be useful for everybody.
Okay, so it's not moving yet. Let me offload and see if I can. How about now? No.
No change.
No change. Let me reload. Sorry about this. I'm gonna reload and see if it's still. Okay, so now what slide can you see?
India's crude imports take it.
Okay. Okay, and if I go back, you see this one?
Yes, India takes lead as big as Asia.
So this is, just to make a quick reference, I just wanted to show you the brown lines that I was talking about earlier, right here, which are representing the Indian volumes. And you can see that India has been importing the biggest amounts of crude from the US recently in Asia. And this is the comparison I was talking about now, that in gray here, we see the Americas volumes, and those Americas volumes that grew to about 1 million barrels per day as recently as February have started to diminish because of the pre-existing commitments that India had for Middle Eastern crude. But we also know that in the current environment, Indian refiners have been trying to curb, whenever possible, the intake of those Middle Eastern barrels within tolerance levels. And we also have been following closely the pricing mechanisms that have been key in terms of the negotiation between, in terms of the volumes that India would like to take, in particular of Saudi crude as one of the biggest suppliers from the Middle East. And we can see that after the extreme volatility that we saw from the Saudi OSPs for Asian clients at the peak of the first wave of the pandemic last year, we have returned to a much more stable pricing environment, where we see again the price of Arab Light in terms of its premium or discount, in this case clearly premium, relative to the average of Oman Dubai, tracking closely the Dubai structure. But interestingly enough, already like it did in 2019, the premium for Arab Light being a bit bigger compared to the backwardation that we see in the Dubai market. But despite that gap, we see that in the latest set of prices that came out last week, we saw that Arab Light did reflect the decline or the weakening that we saw in the Dubai structure, pretty much in line with market expectations. Now, as we go forward, and as Francis highlighted earlier, if we see greater availability of Iranian barrels and the US allowing that to happen, and China continuing to take those barrels, and perhaps the US even being a bit more lenient towards other countries taking those barrels. Of course, the biggest question is how much Iranian crude can actually flow into the Indian market. Because after opening up market for Iranian crude in China, the next big question is how quickly India will return to that market. But that is a question that you'll be in a much better position to answer than myself. But what I'm highlighting here is that that's yet another factor why everybody who produces that type of crude is looking at India, because they also want to know how soon India will be back in the market for Iranian crude. Now, as we see the stabilization of Saudi prices relative to the volatility that we saw last year, we have also seen a growing convergence between the other grades of similar quality to, in this case, Arab Extra Light, namely Murban and Qatarland, in terms of the realized prices of these grades in the Asian market. Before the pandemic and before ADNOC took the bold step to, over a few days, overhaul its pricing mechanism from a retrospective to a forward-looking formula, we saw that there was a bit of a disconnect between the value between Qatarland and Murban relative to the value of Extra Light. As soon as both ADNOC and Qatar Petroleum moved quite quickly to introduce the new pricing mechanism, we saw a realignment and we saw a virtual convergence between those three grades of similar quality. Right now, we see that the latest realized price that is available for these grades is for April loading cargoes. That price obviously became known on the 30th of April. It's still crude that in the case of Abu Dhabi, in the case of ADNOC, Murban was still priced on the basis of against Dubai on the previous pricing mechanism and not against IFAD Murban, or not by IFAD Murban as the settlement of IFAD Murban. And we see that recently both Qatar and the UAE have moved to make their crude more competitive relative to Extra Light. But going forward, and there's just one more month in May where and that's the only OSP that we're missing for Murban now, right? Because now we know the OSP, the actual outright OSP for Murban for April. We also know already the actual outright OSP for Murban for June, because that June front month contract expired on the 30th of April and gave us on average, considering the daily settlements over the course of calendar month April, the OSP for June loading cargoes. And we're only missing May as the last OSP that will still be based on the previous mechanism. And going forward, as we have discussed in previous sessions, the Saudis are going to have a close look at what the price of Murban is. For example, now we already know that the outright price for Murban for June loading cargoes, and of course, when the Saudis set their differentials for June loading cargoes last week, they were also looking at that price already. And we saw that ADNOC actually took a very bold step as well at the beginning of last week, before the working week started outside the Middle East. And they also published the differentials for Upper Zakum, Das, and Lulu relative to the Murban OSP, even before the Saudi OSPs had come out. So before Aramco had issued any pricing signal, you already had outright values for the whole slate or the whole scope of qualities exported by Abu Dhabi, including Upper Zakum. And that pricing relationship between Upper Zakum and Murban today is key for the valuation of that segment of the market led by Murban, or where the flagship and the benchmark is Murban, and that where the flagship in terms of the only grade that is, together with Oman, of course, that is priced freely without any intervention from state oil companies to set their OSP, is Upper Zakum. Well, in the case of Upper Zakum, actually, we still have that differential relative to Murban being set by the national oil company. But market participants have been looking very closely at transactions of Upper Zakum over the course of the calendar month April to try to predict or anticipate what that OSP differential that ADNOC published would be. And if I move forward to this slide here, I'm going to come back to the others. Right here on the left-hand side bottom, we see the actual prices for June loading cargoes of Abu Dhabi crude. And we see that Upper Zakum, right here at the bottom, is priced at 40-cent discount to Murban. That was based on actual transactions that took place over the course of the month. And as you may well be aware, now ADNOC is taking a much more proactive approach in terms of gathering feedback from clients about where to set these OSP differentials. And we understand that last month was the first month that every refiner across Asia got that request from ADNOC to submit that feedback. There seems to be quite a good welcoming from the market for that type of feedback. We've spoken to at least 3 refiners in Northeast Asia who have received such requests, and they provided the feedback. And actually, we've heard that the OSP came out slightly higher than they would have expected based on the recommendations, but still an acceptable level based on the overall value of Upper Zakum compared to Murban over the course of the trading month. And that leads us to believe that, as opposed to taking an end of the month view of the value of relative value of Upper Zakum to Murban, ADNOC is taking, if not an average, at least a more inclusive view of the value of Upper Zakum relative to Murban throughout the trading month. Because at the beginning of the month, values Upper Zakum had been trading at higher volumes, at higher prices relative to Dubai, of course, because that's how the market is trading, but also converting that value to a Murban basis higher. And throughout the course of the month, it started weakening. So that's why expectations that perhaps Upper Zakum would be priced at a 50-cent discount to Murban where but they were reflecting the value that everybody perceived towards the end of the month, while ADNOC might actually have been looking at the average value of Upper Zakum relative to Murban over that period. So the interesting thing to note here is that the introduction of Murban as a benchmark and the introduction of Murban as a futures contract to set the market-based price for Abu Dhabi crude also resulted in an acceleration in the trading of spot Abu Dhabi crude against Dubai. And for that purpose, Argus is now going to start quoting the value of grades that trade against Murban in terms of their OSP, but whenever they trade on a spot basis, they trade against Dubai. We're going to start quoting differentials for those grades against Dubai. And we already had introduced differentials for those grades against Murban. So based on the table that we published last week, Monday last week on the 3rd of May, you can see that the value for Upper Zakum, which is the 4th grade here at -40, matches the OSP that ADNOC published on that day. And this value now will keep moving throughout the course of the month based on reported trades that we get from the market. We saw some degree of liquidity last month that allowed us to very closely track that price, and we certainly hope that that's going to be the case going forward. But if not, we also have the ability to generate a value for Upper Zakum relative to Murban based on a refinery gate value approach, a model that in the absence of trade can help us establish that pricing relationship that is key to compare the value of the lighter grades against the medium sour barrel that is so typical of the Middle East and that can be directly compared with Arab Light. So that's an approach that we haven't introduced yet. We are consulting the market about the introduction of that approach, and we expect that by the end of this month, we will have the consensus from the market to go ahead with such a move. But undoubtedly, over the past month, the key pricing signal for Upper Zakum has been coming out of the tenders and transactions that have been done by participants in Northeast Asia. So we're closely following these developments in the same way that we are following the Murban market. And going now to the Murban market, I'd just like to highlight the somewhat, this chart looks quite volatile because it disaggregates the first 4 monthly contracts for IFAD Murban and charts the total volume by 4:30 p.m. Singapore time, which is the key time for price discovery. And we see, if we focus on the blue line, we see that the front month has been, consistently, let's say on average, about 500,000 barrels per day, which is, roughly 1 cargo, which is a volume big enough to allow for price discovery. And this already turns IFAD Murban into a pricing mechanism that has been successful for Murban itself. Now, there are certainly ambitions to turn that into a wider marker for not only the other Abu Dhabi grades, but also for other grades of similar quality in the region, and also for crude of similar characteristics that is coming from the Atlantic basin. And we come back to the relationship between Murban and WTI. We see that the volumes have also been relatively high further down the curve. And in that sense, if we compare it with DME Oman, it's interesting that at the front month, DME Oman has been having more liquidity. But overall, if you take that front month, that volume for DME Oman, it's comparable as well to the overall volume that is that has been developing around Murban futures for the first 4 months. So there are a few more signs of a sustainable curve developing for Murban going forward compared to Oman, but still the liquidity for the price discovery at the front month and for the physical barrels is still a lot higher for Oman. So in that sense, Murban still needs to gain more traction to boost the volumes at the front. In the past week, since July became the front month, we can see that front month for Murban has been closer to an average of about 1 million barrels. So it's getting there, and that's why we expect that even though right now most or all Abu Dhabi grades are trading against Dubai except for Murban, we expect that there is still scope for them to start trading against Murban going forward. And the fact that Murban ends up having the weight of not only the 1.1 million barrels per day of actual availability that ADNOC forecasts for export going forward, it also will have hanging on it the export volumes for Upper Sakum, Lulu, and Das. And that's why we continue to expect that eventually we will have trade of physical barrels and spot cargoes against IFAD Murban. Turning on to the outlook, in this chart, we see the comparison of Murban as the benchmark, as the zero axis. And there we also introduce the value of ESPO in blue and the value of WTI Houston in orange. All of this using the Singapore timestamp. And we can see that at the end of April, this peak that you see here, let me see if I can point it with my cursor. This peak that you see here for both ESPO and WTI Houston was actually accounted for by the weakness in Murban. And that end of the month weakness in Murban, most people in the market related it to the fact that at the beginning of the month, Murban had been particularly strong. So in terms of achieving a competitive OSP, it had to compensate in the last few days. And also the fact that there might have been some participants who were slightly long in the market. And that accounted for the drop in the value of Murban relative to every other grade, including Dubai and these ESPO and WTI Houston, as we see in this chart. So that's a bit on a review, an overview of where we stand with regards to the pricing of Middle Eastern crude, and in particular as a result of the introduction of Murban as an exchange traded price. And finally, I would just like to turn to the fact that now there is a lot of attention on the value of Murban, and Argus is putting special attention as well in ensuring we have accuracy of the trade that we're reporting for grades that trade related to Murban, or at least for which the OSP is set in relation to Murban, because we understand that the value that we publish is going to be key as an independent reference that participants in Asia can use for their recommendations to ADNOC in terms of where the OSP could be, or where ADNOC could set the OSP based on the trading activity of the previous month. That's what we wanted to highlight with you today. And of course, this is extremely relevant for India at present, as we see sudden changes in demand patterns and in the way that Indian refiners are dealing with the pricing of those grades. So we're very happy to address any questions there might be. Thanks very much.
We would like to wrap up our session today. We'll be uploading the slides to Indian Oil Service Portal. You can find the link in our chat box. And we will also be sending you the email with the link to download the slides. Tomorrow we will be having a similar session on refined products. We'll be deep diving into light, middle, heavy distillates and what is happening in that market and what do we expect in the near term and long term future. So thank you everyone once again and have a good evening.
Thank you, Parimal, and thanks to the Arcus team for such a nice discussion today. And we look forward to tomorrow's presentation. Thank you.